Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Rob Rowan. Today we're kicking off our series on commercial real estate with Barry LePatner. Barry is the founder of LePatner & Associates, LLP. It's a law firm. He advises clients on business and legal issues affecting the real estate, design, and construction industries. And I would recommend you check out his latest book, which is called Broken Buildings, Busted Budgets: How to Fix America's Trillion-Dollar Construction Industry. It covers the national debate that has grown around owners, designers, and other key stakeholders in the real estate space. He also previously co-authored a book called Interior Design Handbook and Structural Foundation Failures, a casebook for architects, engineers, and lawyers. So he's done basically everything he can in the real estate space. So Barry, thank you for being here on Compound Insights.
Rob, my pleasure.
So I would like to start with the state of commercial real estate lending, because it's wild. So could we start with from your view, how lending is going? And please include banks, NBFIs, everybody else.
So let's put this into a historical perspective,
Okay.
because it kind of helps place us in understanding what's going on at the current time. We saw over a period of years, in recent times, interest rates reaching pretty much historical highs that we hadn't seen for a long time in the United States.
Yep.
And those impacted, of course, commercial lending rates, and it affected everything that either was coming into this country, manufactured in this country, borrowings from homeowners, borrowings for commercial real estate. And while we've seen recently that the Federal Reserve has started to lower those rates, they're still at improbably high levels for a lot of commercial lenders and a lot of borrowers. But they're slowly being reduced, and people, at least now, are looking at the world going forward in anticipation that we're going to see continual reduction in rates for a limited period of time, barring something crazy that goes on.
Mm-hmm.
But what that means is that debt service coverage ratios are strained.
Yep.
Everybody's looking at them from different perspectives. Mm-hmm. And nobody has the certainty that when they go to a bank for a loan of $50 million, $100 million or more, that they know how the bank's going to respond.
Right.
So that uncertainty has some implications. And this is especially so for properties that were acquired years ago or were financed years ago when rates were lower.
Right.
They're coming on now. They would like to believe that they're going to refinance with lower rates, but they're not sure that they're going in that direction or staying where they are. And it's challenging, as I said, for those coming off cheaper loans.
Mm-hmm.
It's challenging for underperforming properties.
Right.
And those underperforming properties include commercial offices and struggling urban centers. So when you look at that environment, that historical perspective in the context, you have to ask, what does the current landscape mean? How should we look at this? Right. And so the lending side of the commercial real estate world has seen and is dealing with consistent, significant shifts with interest rates, inflation, which appears to be under control, but nobody is certain about, and economic uncertainty because of political uncertainty. And we could have a lot of political uncertainty in the next few weeks in this country and around the world. So banks are truly being more conservative in their lending criteria than borrowers would prefer to be, and that lenders would prefer to be. But that uncertainty comes back to those lenders and their loan committees, right, and so on. So what are they doing? They're demanding higher equity contributions from owners. They are looking at tightening credit standards. Then you get to non-banking financial institutions, those NBFIs. And these are private equity funds and insurance companies who are now stepping in to fill the gaps that they see exist in the field. A lot of borrowers have to go with them or are choosing to go with an MBFI because they offer more flexible terms, even though accompanying that is higher costs. So if you step back, you see that what everybody in the industry is trying to get their handles on is a comfort level that is not likely to be there for the near-term future.
Right. So there are significant changes due to interest rates and the structure of the lending. But let's talk about this. What do you reckon are the near-term risks to the lenders?
Well, let's talk about the office market.
Yeah, right. Let's start there.
If there was ever a black swan for the commercial real estate world to deal with, it was COVID.
Mm-hmm.
Okay?
Mm-hmm.
None of the many real estate developers I know or have sat down with intensively over the last few years anticipated the full impact of what COVID would mean in terms of the massive departure of workers from offices to become stay-at-home operatives. And this, what came to be known as the hybrid work model, which is a term that I don't know what it means,
Yeah.
but we all know what
We
it
all know what it
means,
means.
decimated demand for office space, where within 2 years after COVID, a tenant who had 100,000 square feet of office space said, boy, it's a good thing in 4 years my lease is up because I'm only going to take 65,000 square feet.
Right, right.
I don't need 100,000,
Right.
multiplied by every floor in the building, so to speak. This also impacted landlords and their lenders because the high vacancy rates and the reduced income streams that followed was insufficient to support loan payments and lease payments and everything else. So landlords themselves found themselves with substantial portions of their tenanted space in a sublease mode,
Mm-hmm. Mm-hmm.
which meant people could have wonderful buildings, A buildings or B buildings at very low prices if
Right.
you wanted to sublease.
Right.
And it was their effort to try to recapture some money that they could put towards their lease payments. Just think about the model that was created by WeWork.
Right.
The whole premise of WeWork, which I told friends at the time, I don't understand. I'm not that smart.
Yeah.
This must be genius.
Yeah.
Is I'm going to rent this space at $54 a square foot, and when I break it up into 6,000 different small parts, it becomes $60 a square foot.
Right.
Hallelujah, I found nirvana.
Right.
My failure to understand proved prescient because it didn't work out.
It wasn't the only problem with WeWork.
It wasn't the only problems. But because of rising defaults, because of property devaluation, lenders have been facing increased risks of default that they have to deal with, especially for loans that were pre-pandemic or dating back to low interest periods. And borrowers can no longer count on refinancing on lower terms, on more preferable terms. The devaluation of buildings, on the other hand, is going to take a long time for it to correct back to some reasonable market levels. And we'll touch on that in a few minutes of what the problems are on that. And lenders are looking at depreciation in the value of that real estate, what their loans are to the appraised value of that real estate, and whether their mortgages are sustainable or not. And that uncertainty is fueling a fair chunk of the real estate market today going forward.
Well, let's talk about one of the things that I think is underpinning some of that. Commute times are certainly something that has convinced people to try to work from home more frequently because most people in this area, commutes are pretty substantial. So let's talk about the state of urban infrastructure, not just here in New York, but in other places too. And you've written a lot about this. What do you think it'll take to break the logjam? And how do you think it would impact prices of offices?
Well, let's get into a helicopter, get up 10,000 square
Okay.
feet and look
Yeah.
down.
Yeah, because I asked a pretty big question there. So yeah.
It's important to see what essential elements are critical to an operating, functional, high-performing urban center. You need lots of employees serving those essential roles. People who come in at 4 o'clock in the morning to start up the boilers, people who are cleaning late at night, people who need transportation all times of day, not just 9 to 5. So you've got to find enormously steady, consistent modes of transportation in and out, sort of like a concertina. It's got it's got to come in, it's got to come out, and it's got to be consistent. Larger, older urban centers have had major problems with rebuilding subways, bus lines, trolley lines. And then, if you are like New York, Chicago, San Francisco, Dallas, or any other large city, you also need airports because people are coming into you as a vital geographic center. And along with those airports, assuming they're good quality airports and they come in, they go out, which has required zillions of dollars of new monies in the last few years, you need quality roads. And of course, accompanying that is bridges. For 40 to 50 years, our country stopped paying attention to roads and bridges. When I wrote Too Big to Fall a few years ago, the perilous nature of our nation's infrastructure and how truly scary it was for the traveling public to be on many of these roads and bridges, there was a significant shortfall of several $1 trillion to bring it up to speed. So by way of example, the American Society of Civil Engineers puts out a report card every 4 years. The last one was in 1921 or 22. And overall, they said America's infrastructure is a C-. Horrible. They talked about a need of $2.5 trillion, and they broke it out into dams, highways, bridges, electric grid, etc. And it was so large, the needs were so large that it boggled the mind. And when I would go around the country and talk to politicians, or I'd give talks to groups of engineers, talks to people in communities, they had difficulty grasping the enormity of what this meant. So I would break it down and I would say, let me explain to you. 4 out of 10 of your roads are in no condition to be driven on. And everybody would start nodding their heads. I said, in your community alone, you have 7 bridges that are capable of falling down at any one time. Because if one piece breaks, being fracture critical and substantially underperforming structural integrity, that bridge will fall, like the I-35W in Minnesota, like the I-5 and Skagit River Bridge in Washington, etc. That happens because it's called gravity. And you can't avoid it because nobody's fixing it, and so on. But what is worse is that statistically, every driver on average pays nearly $1,000 from damage on those roads to their tires, their wheel covers, the axles, to waste time cars in the shop. It's about $1,000 a year, and you just blow it off like, oh, well, crappy road.
And sorry, that's per car.
Per car.
What's the car fleet in the U.S. again?
And when they added them all up, they said it was $130 billion
Yeah, that's where it's going
for
with that.
all drivers in extra vehicle repairs and operating costs annually.
Yeah.
So the enormity of the situation was monstrous. And you see that, for instance, in Baltimore, which is one of those bridges I warned about. A cargo ship knocks one of the piers over. The whole bridge goes straight down because if you damage one piece, the whole piece falls. There's no redundancy. The economic impact to not only the harbor of Baltimore, which is a huge, huge port in terms of stuff that comes in and out of it for our supply chain, but the community, the businesses around it suffer $100 billion, $100 million worth of damage in a very short time economically.
Right.
So I say all this by way of saying that you can't look optimistically to any city to take care of its citizens, to allow its businesses to grow, to have new businesses feel confident they can move into that area, unless the urban infrastructure, the spine, the entire structure that supports all of this is properly functioning. And we have big problems with that. The challenges are we have had inadequate funding.
Right.
But you can point to the $1.4 trillion the Biden industry did.
Yep.
That's going to take 8 or 10 years to be introduced.
Right.
It's
right.
not tomorrow. There's $1.4 trillion.
Right.
In the meantime, more and more bridges are deteriorating. The cost of replacing those bridges or repairing them is going up, as it has been for 40 years. Mm-hmm. And the public is still at risk for those failing bridges, of which there are thousands of them. We need to support public-private partnerships to come in and help our infrastructure in locally, nationally, statewide. We need government action in the way of policy reforms. We need better federal and state grants to update transportation because railroads are important. But remember, you can't put enough into Amtrak to make it work for the following reason. The Amtrak on the East Coast runs very close to the coastline up and down. If you go on the website of NOAA, the National Oceanographic and Atmospheric Administration website, it shows you that by 2050, most of that adjacent property to the Atlantic Ocean is going to be underwater. So I question, and nobody wants to address it, why are we putting in $100 billion into Amtrak for a rail system that's going to be underwater in the next 20 years, 25 years? So we have to start thinking globally, regionally, not just about a particular bridge or a particular road, because the future of cities depends on it.
Look, this is also a separate thing. Just I would recommend everyone take a look at Barry's book. It will make you a little squeamish if you drive, but but it's worth reading. So I want to circle back to something you just said, that there is a substantial number of office buildings in cities like New York and all over the place that have funding structures that won't work at our current interest rates or even for the foreseeable future, right? This will mean refinancing for some. Some are already getting it, right? And default for others. So where do you obviously been around for a while, you know a lot of shrewd investors. What are shrewd investors looking at in the office sector right now?
So let's take the typical office center, whether it's New York or Denver, San Francisco or Chicago or any other city.
Yep.
When you get back into that helicopter and go 10,000 feet into the sky and look down, you're able to see a few nice, shiny buildings. Nice. You see buildings that are 25 years old, which, wow, goes back to 1994 or something like that. Well, that would be 30 years old. Right. And then you see, wow, buildings 1980 and 1970, which still look okay, modernist. Those buildings have 50 and 60-year-old mechanical, electrical, and plumbing systems. Right. Okay? They were built for a specific purpose at a specific time for a specific market. They have 8-foot ceilings. They're very nice. But today, we know that if you want to attract quality tenants of any size or any company to your building for a lease of 10 or 15 years or more, you've got to give them amenities. You've got to give them wireless. You've got to give them airflow, circulation. Many of the companies are very concerned about environmental and sustainable problems. those buildings that are 50 and 60 and 70 years old are major sources of concern to their owners. They're major sources of concern to their lenders for natural reasons.
Right.
And what is the source of that? Well, somebody could come in, renovate the building, and bring it up to speed. But putting in new mechanical, electrical, and plumbing, what we call MEP systems, may not be enough. Okay?
Right.
Because we need to adapt the roof, and lots of attention is going on to what goes on the roof, recapture rain, run it through the air conditioning systems. All of these things entail a gut renovation. So as a result, anybody who realizes they have a 50, 60, or $100 million renovation to bring these systems up to speed, it has to be reflected in the underlying appraised value.
Right.
Unfortunately, some buildings don't have enough value to support that amount of renovation. So what are some owners, some private investors thinking? How about we convert some of those office buildings into badly needed housing, multifamily housing?
Right.
Okay. Great idea. Government says we need them. Two problems. Any office building that you are in probably has a nice little square footage for men's bathrooms, another one for women's bathrooms, and that's where all of the plumbing supply goes. I now want to convert that into an apartment building where I'm going to have 4, 6, 8, 14 apartments on the floor. I've got to run bathrooms and kitchens into each one of those apartments. The cost of that is arithmetically restrictive because when you start to design that, when you sit with the architects and the engineers, and you factor into that, I need to have on top cooling towers. I may have to have below the heating pumps. I may have to have a whole series of MEP systems that are supportive of these all around the building, and bring in new, attractive, state-of-the-art, sustainable, and environmental systems. The cost becomes prohibitive. And so the appraised value of that property goes down.
Right.
For someone to invest all of that money into a building that is really not suited for that conversion costs a lot of money. So we need to understand how critical it's going to be if we're going to, A, provide some support for those building owners who want to make this conversion, want to believe in the future of their building in that city, as opposed to selling the building and going and buying an industrial property in Omaha.
Somewhere, yeah.
We need government to create smart subsidies.
Okay.
Because we need to solve a housing problem, which is greatly needed in almost every city in the country. We've got to get all sorts of people into better housing. We want that housing because we need those critical workers at a fair value to work in the city and not come an hour and a half in from every place, because that's exhausting, and it's also a time bomb that eventually people just say, I'd rather work locally in the suburb than come all the way into the city with outdated infrastructure.
Yeah, or the exhaustion leads them to make mistakes in the very critical things we depend on. Right.
Yes. So what we're looking at is a unique timing in our real estate world where we need the combination of government to come together with private interests in a workable system that benefits private industry, lenders, homeowners, because it has to be fair priced in the community, and make it viable for people to commit the reconversion of those outdated buildings into modern, new facilities that benefit the city for the long term.
Okay, so conversions made a sort of big splash a couple of years ago, in that, they were building sort of visually appreciable things. and these were interesting. But one of the things that always occurred to me is that there are a lot of local laws that impact that. So if we get back in the helicopter for a second, is there a good model out there from a policy side that works well? Or are New York, Chicago, San Francisco all in the same boat from that perspective?
Well, you think about what the word regulation means in terms of buying a property with zoning problems,
Yep.
other city urban environmental issues, beginning to plan it, get approvals. It's a 7 to 10 year process.
Right.
Okay.
Right.
Realistically, and I believe we need a certain amount of regulation. We need safety for workers.
Sure.
We need safety codes. We
Yeah,
need
sure.
codes that say we're going to get fire resistant buildings and so on. But we need to look very closely, and we need a respected team of people to say, is it time that some of these regulations have just been layered on because it was a time that they could be layered on. People were making enough money on their properties, so they didn't care if they were required to build something a half mile later to run into a subway line. Right. We have a lot of those regulations. We need to smartly reconfigure them. We need to smartly cut away those that are unnecessary and are adding 6 months here and 6 months there. Because if we're going to achieve a smooth process out of this quagmire that we're in, and it is a quagmire, and don't want it to be a 10-year process, we want it to be a 5 or 7 year process, we're going to have to undo those regulations, which are burdensome without a high level of import for justifying why it should stay.
Mm-hmm. Mm-hmm. I guess one of the things so I wonder, that seems like a tall ask. I mean, New York City is required to change in zoning for about, check now, 20 years. So, it's been a while. And, one of the things that I always was a little, as an investor, that makes this very difficult, right? Because you have a time horizon, if the alpha to your time horizon is really long and quite uncertain. So do you think there's enough groundswell, or do we have to have some buildings come up and be revalued at $82 million less than their loan for the government to get in the game here?
We have developed a knee-jerk NIMBY response when it comes to development.
Right.
Because we associate rich people who are making lots of money at my expense,
right,
says everybody in the neighborhood.
Right.
Got to get into a room and have the conversation that a healthy, warm, inviting city that is an economic vehicle that benefits all requires us to ask a few questions that we can all agree we don't need certain rules and regulations, or we can make them a 1 month process instead of a 6 month process.
Right.
Or we can ignore them if you combine that with something later on that justifies it.
Right.
Instead of sequentially tacking on everything that makes it a 4 year, 6 year, 7 year process. We need that common sense, because the city of the future is going to be a city of vibrancy, which I'm certain about. The city of the future is going to have excellent transportation in and out of the city. The city of the future is going to include young people who want to be here. It's going to include workers who are paid decently and are not living an hour and a half and 2 hours away. And the city of the future is going to include cultural aspects, sports, entertainment aspects, all that make it vital and enriching so that you're excited about it, because if not, the quality of life is better elsewhere.
Right. Right.
I've always been an advocate that says, if you don't take advantage of all the features of a city, the culture that includes theater and museums, and if you don't enjoy the vibrancy that the city gives you, because It's filled with people who are great at journalism, great in academic world, and the other things that we take credit for, cities being vital.
Uh-huh.
You shouldn't be in the city
Right.
because there are better places to live.
Right.
But when we have that as a base understanding, Rob, what we do is we can reach agreement on what holds us back from achieving that high level of standard for what we want.
Well, I cannot think of a better, more hopeful place to leave this podcast than that. Barry, thank you. That is a phenomenal sentiment, including encouraging all the people here to who live in New York to take advantage of the museums too. Um, so, so thank you, Barry, for being here on the podcast.
Oh, thank you, Rob. Always happy to be a guest of the podcast.
And thank you to everyone who listened into this podcast. This is the first episode in our month on commercial real estate, so tune in for the next one next Monday. Until next time, I'm Rob Rowan, your host, and this has been CFA Society New York's podcast, Compound Insights.